Hello and welcome to CommBank View, Economics and Markets, where we unpack key issues each week with expert voices from among the economists and strategists at CommBank. I'm Mandy Drury and I'm always delighted to be your weekly podcast host. So this week we're talking about China. This is an economy that is indeed Australia's largest two-way trading partner, buying about a third of all Aussie exports. Chinese students and tourists also provide billions of dollars to Australia's service sector. So the strength and stability of China's economy is vital to our own. So what is the outlook for China? Well, let's ask Carol Kong, who is economist and currency strategist. And she joins me now. Hello, Carol. Thank you so much for joining us today on the podcast.
Hi, Mandy. Thanks for having me.
So the headlines about China's economy seem actually quite confusing. We're getting some mixed messages here. On the one hand, sometimes we hear it's in deep trouble, and then another day we might hear that exports are booming. What's actually going on?
Yeah, so the headlines can indeed be very confusing. Both are actually correct. So the best way that I would describe the Chinese economy is actually it is operating at two speeds. So on the one hand, you have the export economy. So that's the part of the economy that manufactures goods and ships to the rest of the world. That part of the economy is actually booming and doing remarkably well. And especially considering the fact that, China had experienced two major external shocks in the past year and a half. So first you had the Liberation Day tariff shock in April 2025. Then you had the energy supply shock caused by the Middle East conflict started in late February, and that is still ongoing. But despite these headwinds, exports in China have grown very strongly, in part because Chinese manufacturers were able to find new export markets. But there was also a genuine increase in demand for Chinese exports, particularly for green energy goods such as electric vehicles and also solar panels, but also AI. So demand for AI hardware like semiconductors has also grown very sharply over the past few months because of the global AI capex boom. So from an export perspective, the Chinese economy is doing very well. But like you said, on the other hand, we've got the domestic economy, and it is telling a very different story. So consumer confidence and also consumption has been very subdued. Private investment has also been very weak. So, I think that's, mainly because the fact that the property sector is still very much struggling. So if you only read news on the Chinese consumer and the property market, you'll probably conclude that the Chinese economy is in pretty poor shape.
So in this two-speed economy, as you describe it, Carol, you've got good exports on one side and you've got struggling domestic economy on the other. So let's just unpack, first of all, the export side of things, because they've really done the heavy lifting for economic growth. And part of this, I understand, is that they've been buoyed by transshipment through East Asia, and also diversification to Africa, Latin America, and other economies like the EU. And yet I'm confused because the United States said that it was going to be cracking down hard on transshipment. So why didn't they follow through with that tough talk?
Yeah, there was tough talk on transshipment early on in 2025, but the US didn't really want to actually crack down on transshipment because the US ultimately still needs those goods. So what we actually saw in 2025 was Chinese exporters have basically been rerouting those goods via Southeast Asia, like you said, and ultimately to the US. And we just haven't really seen an actual enforcement of those crackdowns, measures yet. Direct exports to the US have actually grown very strongly in the past couple of months. So, demand in the US has been genuinely strong still for Chinese goods.
Okay, so let's go back to the domestic side of things, which as you rightly say, has been continually dragged down by the property sector. Why has the property downturn had such a large impact on Chinese consumers?
Yeah, so I think anyone with a mortgage can probably relate to this. When the value of your home is rising, you'll probably feel wealthier. You'll be more comfortable spending, renovating the home, taking a holiday. But when home prices are falling, you'll be more cautious in spending, right? So this is what economists call the wealth effect. And what's different in China is that this wealth effect is a much bigger impact there. So that's because of the outsized role housing plays in household wealth. So housing basically makes up about 70% of Chinese household wealth. That figure is about 60% here in Australia and about 30 to 50% in other high-income economies. So when home prices are falling, that impact on consumer confidence and actual consumption is a lot bigger in China than elsewhere. And to give you an idea of how big the property sector downturn has been in China, established home prices have actually fallen by more than 20% since the peak in 2021. 20%, that's a huge fall. So instead of spending, Chinese households have really been focused on, increasing their precautionary savings and also paying down their debt. Now, the government very much wants to make household consumption a bigger driver of economic growth, but that is very difficult to achieve when the property sector is still under this much pressure.
So that's really interesting. So on the one hand, you've got Beijing policymakers who would like to boost household consumption, but at the same time, they understand that property deleveraging was a necessary evil. But in previous slowdowns, Carol, China has responded with massive stimulus. Why isn't it doing it this time?
Yeah, so that was probably the biggest difference between China today and China 10 or 15 years ago. So in the past, whenever growth started to slow, the playbook was fairly predictable, right? Basically, the government would build its way out of any problem. So the government would loosen credit, ramp up infrastructure spending, build more apartment buildings, basically to kickstart another investment boom. That formula worked for decades and really helped China achieve very high rates of economic growth. But that now went out the window, right? And, it's not because policymakers suddenly forgot how to stimulate the economy. It's basically because policymakers now believe that the old growth model has run its course. So, after decades of debt-fueled investment, policymakers now see the economy too reliant on debt, too reliant on construction. So they don't really want to go back to that old way of propelling growth anymore. Each new round of stimulus also saw less and less benefits. Property is a very good example. So building more apartment buildings made sense when millions of people were moving into the cities and demand was booming. But it's very different, in today's world, right? The China's population is shrinking and aging. In many parts of the country, there is actually an oversupply of housing, which is the very opposite of what Australia is experiencing right now. So building more apartments just to boost growth just doesn't make sense anymore. So instead of maximizing GDP growth over the near term, policymakers are now trying to improve the quality of growth over the next decade.
Yeah, that's okay. So just sort of picking up on that, if you say that China is not trying to revive the old growth model, that it's run its course and it doesn't really apply to today's world, what exactly does that new growth model look like?
Yeah, that's a good question. So the phrase that you often hear from Chinese policymakers is quote unquote high quality growth. So that's a really important way of understanding where the Chinese economy is heading in the future. So like I said, in the past, for decades, the old growth model was built around property and infrastructure. Now, that's basically reached its limits, according to policymakers. The next stage of China's development is going to be focused on productivity, innovation, and also advanced manufacturing. So that's basically what high quality growth is all about. The government's long-term vision is to build a, more resilient and more self-reliant economy, an economy that leads in industries that will basically define the future. So these are industries like electric vehicles, batteries, semiconductors, robotics, and also AI. And the idea is that these industries will generate higher productivity and higher value-added production and ultimately higher incomes. And from Beijing's perspective, that is the foundation for increasing household consumption over the long run. The government wants to make household consumption a bigger source of economic growth, but they believe that the way to get there is to build a more productive economy rather than delivering short-term stimulus like handing out consumption vouchers. And there is also a geopolitical dimension to this. So Beijing now increasingly sees technological leadership as central to not only economic prosperity, but also to national security. So, policymakers really want to narrow and ultimately surpass the US technological lead in critical industries like the ones that I just mentioned. The Chinese policymakers don't really want to rely on foreign tech and imported supply chains anymore. They want to build a self-reliant economy. And I think the recent export controls by the US basically just strengthened Chinese policymakers' resolve. So I think the goal has fundamentally changed. The goal is no longer to maximize headline economic growth, but it is to really build a productive, innovative, technological-driven economy. So Beijing has really shown its willingness to accept slower growth and also maybe some pain in the domestic economy if it means that it is meeting those strategic priorities over the long run.
Right. So it's not just about numbers here. It's about national security. It's about self-reliance. It's about resilience, moving up the value-added chain in manufacturing, becoming more internationally competitive as well with the industrial modernization in key critical sectors. How do you feel that they're faring on that score so far, Carol?
I think they're getting there. Chinese have really gotten very competitive in, those technological advanced industries. For example, AI and robotics. I'm sure you would have seen videos of those humanoid robots, dancing and doing kung fu on stage, making your coffee, delivering your food to your hotel rooms, and, even sorting and doing complex jobs at factories. So I think, because of the massive investment in advanced manufacturing, the Chinese government is really getting very competitive in those sectors as well. And I think, given the strategy going forward, it is willing to, sacrifice lower, headline growth for the long-term priorities. I think, this is the direction that the Chinese economy is heading in the future.
What are the downsides, though, of this strategy, Carol?
So I can think of two big ones. So the first one is that household will be the loser here. So Beijing has made a deliberate choice to prioritize investment in advanced manufacturing and technologies over short-term stimulus. And in terms of the property sector, like I said, it plays a very important role in household confidence. But the government hasn't really done a lot to turn around the property sector. It is doing some piecemeal measures to help stabilize the sector, but it doesn't really want to engineer another boom in the property market. So given that, I think household confidence and ultimately actual spending will remain very sluggish, at least in the near term, and that will remain a drag on the broader economy. The second downside, I think, is just growing trade tensions between China and its major trading partners. So as manufacturing capacity expands, domestic demand in the Chinese economy hasn't really kept pace. So those products that China makes will have to find the buyers overseas. And that has helped China achieve massive trade surpluses, but also generated trade tensions with many of China's major trading partners, such as the US and the European Union. And that has resulted in some trade restrictions on the Chinese economy. And I think going forward, given the concerns those trading partners have over China's economic imbalances and also the trade surpluses, we're going to see more and more protectionist measures and trade barriers from overseas.
Mm-hmm. So Beijing policymakers essentially have a few headaches that they need to stamp out. And we've been talking about the property downturn, which has been a really tricky one to tackle for the reasons you've laid out. But another one is, of course, this low-flation rut. And you've got Beijing's anti-involution campaign, which is a strange term, but essentially it's aimed at tackling the industrial overcapacity and excessive price competition. But it's also placed downward pressure on investment. How do they get out of this low-flation rut or sometimes even deflation rut?
So, to be precise, China is no longer in deflation thanks to the Middle East conflict. So because of the sharp rises in energy prices, inflation is actually now positive in both CPI and PPI terms. So we just got, an update recently. China is no longer experiencing deflation like it has in previous years. But in terms of your question, I don't think China is going to get out of this low-flation rut very easily because of the exact reasons that we just discussed. Weak domestic demand because of the struggling property sector is going to remain a drag on, the broader economy and therefore price pressures. So I don't think, this is something that, the Chinese government will solve in the near term.
Carol, how does Beijing tackle the big structural challenges that you mentioned, like a rapidly aging and shrinking population? That's a much more difficult nut to crack, isn't it?
Yeah, that's absolutely true. So China has done various things to try to boost the birth rates, but according to the United Nations, China is going to still experience a pretty big demographic decline. So the working age population in China basically peaked in the last decade at 1 billion, and the United Nations forecasts that population is going to fall to just 300 million by 2100. And I think the way that China is going to solve the impacts of a demographic decline is just to invest more in automation. So China has invested very heavily in robotics and also AI. So like I just mentioned, we've got so many robots, being rolled out across, factory floors and also the retail industry. So I think China is really betting on the technology to really help boost the productivity side of the economy rather than relying on, having more workers do more work for the economy.
So it sounds like there are challenges in the economy, but also there are incredible opportunities. And the Chinese economy is too big and important to the global economy to ignore. So looking ahead, Carol, what should investors and businesses expect from China over the years?
So I think the biggest thing for Australian businesses and investors to recognize is that the Chinese economy is not going to grow at 8, 9, 10% like it did 10, 15 years ago anymore. I think those days are certainly behind us. Growth of about 5% is considered a good year for the Chinese economy today. And I think that number is going to keep stepping down in the future because of the demographic decline that I just discussed. And I think that will mean, the composition of the economy will change as well. Like I said earlier in the podcast, China is going to focus very much on advanced manufacturing and technology. So in the past, Australia's fortunes were very much tied to, iron ore and also Chinese demand for steel. That may, decline in importance in the future as China focuses on advanced technology rather than the old infrastructure and property sectors. So I think that is something that Australian businesses will have to keep in mind when they analyze the Chinese economy going forward.
Is it fair to say that the geopolitical landscape is going to remain a major wildcard for not just the Chinese economy, but also the global economy over this year and maybe even the next year, as we sort of see the external environment as the West is focused on de-risking, it could become potentially more hostile to China.
Yeah, that's absolutely right. So, like I said, we've got so many Western economies already being hostile to the Chinese government because of the massive trade surpluses China has achieved in previous years. And we've already seen many of them impose different restrictions and tech controls on the Chinese economy. And I think that will continue to be a theme going forward as China continues to rely on this export-led growth model.
Really interesting, and thank you so much for joining us today talking about the outlook for the Chinese economy. Carol Kong. Before we let you go, let's get a look at the week ahead in the markets with Harry Ottley, economist at CommBank. Hi there, Harry. There's so much conjecture right now about what the Federal Reserve in the United States is going to be doing. And CPI, consumer prices, are going to be important as always to watch. Give us your views on what we can expect.
Yeah, thanks, Mandy. So obviously CPI always very important in the US, and it comes at a really important time for the discussion around what the Fed is going to do. It's very extreme at the moment, the debates going on around the markets and also around the FOMC table around what the right next move is for the Federal Reserve. And we had the weaker payrolls data last week, so we saw payrolls unexpectedly fall in the month. And so that brought on some talk around the labour market being a little bit weaker and possibly pushing back the expectation for interest rate hikes from the Fed. But we would note there that the unemployment rate did stay steady at 4.1% in the month. So it's not like there's emerging slack in the labour market, albeit the payrolls was a little bit weaker. And so with that data now in train, we can look forward to the CPI, as you said, which will provide the next update on the inflation side of the mandate for the Fed. So we think that core and headline inflation will be up by 0.2%. In the month, but we do think there are some upside risks there, and we still do remain of the view that the Fed's next move will be up in December, which is around the market pricing and the market expectations at the moment. But clearly that CPI will be very closely watched, especially coming off the payrolls report.
Most certainly. Another thing that we're watching, of course, is the continued softening of the Australian housing market. We've got home lending data coming out. What's that going to tell us?
Yeah, so probably not normally a release locally that would really get a lot of attention from markets, but you're right, given the slowdown in the housing market in Australia, we heard Carol earlier talking about the wealth effect in China. It's also very important in Australia, so people are watching closely how the housing market is performing, especially after those budget tax changes, which we've all discussed quite a lot in the last few months. And so this official lending data from the ABS will give us the first look at how much investor lending has dropped as a result or after those budget changes. And so it'll cover the second quarter of the year. So we'll get a little bit of data and an update on possibly how much people are pulling back from investing in housing and housing lending more broadly. We'll be looking at obviously the impact of the budget changes, but also you have to remember interest rates have been moving up. It's an uncertain environment. So you'd expect lending to drop. It'll just be a question of how much.
Indeed. And last but certainly not least, we're always monitoring events out of the Middle East. How are they likely to impact the markets this week, Harry?
That's right. So with all the usual caveats around the information flow changing day to day, the latest from our point of view is that we are looking like there is a little bit of progress in terms of the deal between the US and Iran. Our base case is now that we'll get a deal to reopen the Strait at the start of September. We put that at around a 55% chance of that occurring. Obviously, that's very close to 50%. It's an uncertain environment, but our base case is that the signs have become a little bit more positive. We do maintain, though, that for a deal to happen, we think the US will have to make some concessions. We think Iran has a lot of leverage in this situation. But overall, we think it's broadly moved in a positive direction of late. And as I said, expecting a deal to reopen that strait sometime in early September.
We're certainly hoping so. Thank you so much for laying it all out for us, Harry Ottley. And thank you for joining us for this episode of CommBank View Economics and Markets. Make sure that you join us every week at the same time. I'm Mandy Drury. I'm your podcast host, and it's been my absolute pleasure to have you listen in.